All right, good afternoon, everyone. Welcome to our second and final panel of the day. We're going to continue with the theme of valuation and fund governance as it relates to responsible retailization of private markets. I'm Blair Burnett, Branch Chief in the Division of Investment Management's Rulemaking Office. I'll be moderating this discussion along with Michael Vapublicano there at the end, an Assistant Chief Accountant in the Division of Investment Management's Chief Accountant's Office. And just like Brian, before I continue, let me just restate our standard disclaimer here. Our remarks today are provided in my official capacity as branch chief and Mike's official capacity as assistant chief accountant in the Division of Investment Management. Our views do not necessarily reflect the views of the commission. The commissioners are other members of the staff. All right, with that out of the way, we have a great panel this afternoon with a ton of expertise on these topics. I guess we'll start. I'll just ask each of the panelists to briefly introduce themselves, and then we can get started. I'll start with Pete here.
Hi, good afternoon. I'm Pete Driscoll. I am a partner at PwC in the national office. I split my time working with investment advisors, funds, and broker-dealers, and then also doing consulting work. Prior to joining PwC in 2001, I was here at the SEC for about 20 years, was in enforcement in the exam program.
Good afternoon. I'm John Mann. I'm a partner in Cleary's Global Funds Group. I also started out my career at the SEC. I was actually in the Division of Corporation Finance for about 4 years. And when I left in 2004, ever since I've been working basically with 40 Act products and 40 Act adjacent products that are in the alternative asset space.
Good afternoon. I'm Jamila Abston Mayfield. I'm the Chief Regulatory Services Officer for Comply. Comply is a firm that sells services, software, and education to financial services companies. Prior to that, like the other panelists, I'm a former SEC exam assistant regional director. I also am a former EY partner, so happy to be here.
Good afternoon. My name is Blake Nesbitt. I have never worked at the SEC. As I've told these gentlemen, I hope to when I retire. I am Chief Investment Officer of a company called Cliffwater. We manage about $45 billion across 3 interval funds. 2 of those invest in private credit, and our third, more recent fund invests in private equity.
Good afternoon. My name is Brian Morris. I'm an audit partner in Deloitte's investment management practice. I'm a former SEC fellow. I was here from 2007 to 2010, and ever since I've been serving predominantly large asset managers, mostly in the 40 Act space, also in the alternative space, and I'm very glad to be here today.
All right, so we'll get started. I'll just set the table here. So as discussed by the chairman and the director today, the commission has an important mandate to ensure the responsible retailization of private markets. And at the heart of this mandate is thinking about how the commission can reduce regulatory barriers that prevent retail investors from accessing diverse investment opportunities in the private markets, while maintaining, of course, core investor protections and appropriate safeguards. Before we kind of jump in and unpack these topics, I think it's worth taking a step back to articulate the regulatory boundaries as it relates to the investment vehicles that offer exposure to private markets. The bulk of our discussion today will be on Rule 2A5 under the Investment Company Act of 1940, which applies to registered investment companies and business development companies or BDCs. While a meaningful amount of retail exposure to private markets is taking place in 40 Act registered vehicles, that's not universally the case. So I guess the first question, and I'll direct this at John, as we think about multiple ways for retail investors to gain exposure to private market strategies, can you just give us a lay of the land regarding the regulatory landscape and the different types of offerings you're seeing, the difference in the regulatory regimes that investors should be aware of, et cetera?
Yeah, sure. Happy to, Blair. And I'll try to keep it really high level. I mean, I would break it down into a couple different buckets. As you mentioned, there's obviously the 40 Act regulated products. So that includes BDCs. It includes registered closed-end funds like interval funds and tender offer funds. I think the second big category, which actually was probably more active in the private wealth space even before the 40 Act products came in over the last few years, were REITs or real estate investment trusts. So they are not subject to kind of the 40 Act overlay, but they have their own separate set of disclosure obligations under the Exchange Act that are specific to real estate funds. The third bucket, which is relatively new entrant into the space, are what I'll call Exchange Act registered private funds. So they are, for 40 Act purposes, private funds. So that means every investor is an ultra high net worth individual, what's called a qualified purchaser. So they have to meet relatively high thresholds to be able to invest. But they have enough investors that they actually are Exchange Act reporting. So they file 10Ks and 10Qs. So a little bit of a hybrid from that perspective. But the key thing is they do fall outside of the 40 Act overlay. So some of the 2A5 processes we'll be talking about don't actually apply to them on their face. The next category is something which I think has always existed, but I think is about to likely take a probably more prominent role, and those are bank-managed common investment trusts, or CITs. Those are also outside of the 1940 Act. They operate very much like a private fund in a lot of ways, but with a bank as the key manager or advisor to those products. But those are also something that there's a lot of discussion around as far as being kind of a key component of the retailization on the 401k side. So I think obviously subject to where the rules come out, CITs I think are going to become more prominent. And then the last point I would just mention, just touch on briefly, is sort of the illiquid sleeve concept within mutual funds. So we're seeing this a lot around target date funds. I think that was mentioned on the last panel. I think that's also something that on the 401k side is going to become more of a more prominent thing. And that's basically a small percentage of mutual funds are able to be invested in illiquid assets. And if you take something like a target date fund that has a long time horizon, that's something where, putting in sort of some of the alt assets we'll be talking about might make sense because of the longer time horizon until really people would be redeeming out from those funds. And that is, unlike some of the other examples I just talked about, that those types of mutual funds would be subject to like 2A5 and the whole valuation process with respect to even that illiquid sleeve. And really the structure that you choose kind of falls into two broad categories as far as why you might choose one over the other. The first is the asset class. Some asset classes just don't work in 40 Act funds. Real estate tends to be a REIT for obvious reasons. That's just the best structure for it. And the second thing, though, and it's something that I think may not be as well understood by the public, but it's a critical component, is really the distribution channel. And I know we're going to talk about it in a minute, so I won't steal the thunder around interval funds, but an interval fund versus a tender offer fund, they operate very, very similarly, but there might be a reason why, because of the distribution channel, an interval fund is a better option to be sort of offered through that channel to investors rather than a tender offer fund, and vice versa. So each structure kind of has its own place within the overall private wealth channel framework. And the last thing really just to touch on, Blair, to your point, I think it's critical sort of for the public when they're looking at these vehicles to understand where the 40 Act is sort of applying its overlay and where it might not be. I think with the caveat that to the extent you have large sophisticated asset managers that have large platforms, some of the processes they develop because they have 40 Act products will necessarily end up being applied to the non-40 Act products. So there's a little bit of crossover there, but it's still important to understand maybe some of the protections that, say, a 40 Act product applies may not necessarily apply to a non-40 Act product that's being offered in a similar distribution channel.
Blair, you said we can jump in, right, on this? Well, I think I just want to highlight, because what's really timely is the conversation of private markets and alternatives going into retirement markets. And John mentioned, I think it's really important that people are aware, collective investment trusts I think now represent over half of the retirement market for good reason, because it's target date funds. But I didn't even know until a handful of months ago that it's an entirely different regulatory regime, And so I think it's just important for the public to be very aware when you're maybe migrating in and out of different regulatory regimes, 40 Act, SEC-governed structures, or a different governance oversight structure.
John and Blake, thank you very much. Very helpful. And today, we'll focus the conversation on 40 Act vehicles. And so, Brian, my question's for you. Now that we've centered the conversation on 40 Act registrants, how does a combination of a process-focused rule, so 2A5, and a principles-based accounting requirement, ASC 820, shape valuation practices? And where do you see firms typically excel and or struggle in applying judgment?
Excuse me. Thanks, Mike. Maybe just to start, I'd want to level set on a couple topics. First, and I think the last panel did an outstanding job on level setting on two of the three things here. One is just the overall importance of valuation and getting that correct. Obviously, valuation is a benchmark for measuring the performance of the manager, but under the 40 Act, it's also sort of the determination of the net asset value for fund shares, and so it's really rooted in fairness that we get this right, so all shareholders are treated equally whether they come into the fund or out of the fund. So that's very important. The other thing that I thought they did a great job of talking about, just the difference between the market structures and for public and private securities, and how there's clearly a lot more judgment required for alternative investments, particularly private equity, private credit, and others, because there's just not developed either observable markets or just they're much thinner. So those are just important things to acknowledge. And then the third thing I just wanted to highlight, and that is just in the 40 Act construct, the importance of the oversight model that is driven by the board of directors. And Rule 2A5 and just is the recent rule from the commission really set just some good expectations about how the board will work with the advisor in the valuation process. And I would say that it's also worth noting that it's very flexible in terms of what it establishes. So I think those are important things to kind of get out there. I also just want to acknowledge, and I think one of the other panelists mentioned this in the first panel, that alternatives in the 40 Act space is not new. I mean, we've been talking about that as well. Business development companies have been around for a long time and have had private credit in them. And then there have been some pioneering managers that have actually been successful at deploying limited amounts of alternatives, even in open-end products. And so I think and then, of course, we have a big development in the sort of the kind of the semi-liquid space in the 40 Act with like interval funds and tender funds. And so I guess, and this maybe goes into my observation. So I've had the benefit of, as an auditor, being at the table in the board discussions to see the development as 2A5 came out, and also working with managers that are comfortable with alternatives. And so I got to see how that works in practice. What is interesting is that, of course, you'd expect the tenor of the conversation for a board that oversees equities is very different than one that is steeped in private credit valuations. And so the types of things that are being discussed at the board between manager is going to vary, and as you'd expect. But I think it's been, my observation is those that are comfortable in the alternative space are comfortable with developing a repeatable valuation process. They're also, under the rules on 2A5, they provide data about the results of their back testing. They talk about how they incorporate specialists when they need specialists, and sort of the results of the work that they get there. And then again, all of this is subject to just broader checks, like, for example, the audit, the annual audit, where all the valuations are subject to testing by an outside party. So yes, so far, I mean, my experience with this has been one that just the industry has taken steps forward, and those steps make sense sort of in what we see in the framework. Of course, I mean, sure, some of you guys have some similar observations as well.
I do, and Mike, I'm happy to jump in here, but absolutely also okay to take a pause, whatever you want me to do.
No, jump in. You're actually going to you next, so go ahead.
Great. Ryan, you really laid a lot of stuff out that I wanted to mention, and like everybody, I think we all want to kind of level set, so I want to back up and just kind of give you the 2A5, like, compliance greatest hits. So I'm going to start at the top and run these down, and then I think that'll give color for everybody so we know what we're talking about. So first, and Brian laid this out, right? There's a responsibility that was codified by 2A5 for the board or their designee to own the valuation. And that was already happening, but like nail and coffin, you own it, or your designee, typically the fund investment advisor. So that's kind of the first thing, responsibility. And then next is policies and procedures. Detailed, really laying it out, how you're doing this, how you're governing the valuation process. It needs to be crystal clear. It doesn't need to be some, canned policy from somewhere, but really tailored to your fund. Risk assessments, next. These need to be done annually at the very least. Some firms do them semi-annually to really figure out what are the risks to the valuation process. Is it data, transparency? Is it timing? And write those down and how you're managing those risks. So that risk assessment process, absolutely something that came out of 2A5. Methodologies. So are your methodologies appropriate for the asset class? Have you codified this? Or is it still loosey-goosey, using what you feel you should use every quarter? So really getting that nailed down as well and making sure that, as you said, Brian, you're testing them and you're back testing them. Are you looking at exit prices and comparing them to what your performance valuations were the quarter before and really doing some mapping? Do you do that often? Do you do it every 2 years? So methodologies, but then testing, right? Monitoring. Are you monitoring? A little bit different than testing. That's the overall program. Are you sure that it's working? All the things that you wrote down, are they implemented? Because you don't want the SEC to come in and ask, yeah, this is great, looks good on paper, but are you actually doing all these things? So monitoring is another one of those greatest hits. Pricing. Are you using pricing services? How did you do due diligence on them? How are you holding them accountable? When you have pricing challenges, what is the process for that? Is this all written down? Again, you're going to hear me say documentation, documentation, documentation a lot. So that pricing piece is big, right? There's an expectation that you're using outside pricing, but what does that look like? And, is it real? Supporting cast members. I like to call this the auditors, the consultants, the fund administrator, the pricing services, anybody and everybody that's helping you do valuation. Have you understood the due diligence process on them? Is it done every 2 to 3 years? Are they the right people for today's fund versus yesterday's fund? Really making sure that also is codified is important because that's going to be something any regulator would want to understand. And then the reporting. So you have your regular reporting that the board wants to see, how the valuation process is done, how the sausage is made. But then you have those material deficiencies, significant departures from your normal process or departure on an actual asset. What happened? Give us a kind of play-by-play and then tell us where you're going to do to prevent that or help us understand in the future. That's the board's thinking around some of those deviations. And then finally, valuation committees. I know I want to mention this because John mentioned it on the last panel. I thought this was great. This is a way to give yourself a little bit of buffer and leverage as a fund and make sure you have other folks that are not just one person or not just the head of valuation driving, but maybe the CCO's in there, the accountants are in there. Some other folks in the firm are in there listening in and can offer some input on valuation. Minutes or no minutes, there's been a lot of debate here, but a lot of firms have minutes so they can make sure that they hold themselves accountable to what was discussed. These are things, again, that in my mind, greatest hits for compliance. So hopefully that was good, Mike. I'm happy to share more, though.
That was great. I'm just glad this will be recorded so I can add to my playlist. That's good. But you said something interesting. You talked about multiple people coming to the table, regulatory accountants, auditors, lawyers, much like today, we're all at the table talking about this. And so maybe it's more metaphorically, but Pete, I want to talk about your thoughts here. So when you think about that, think about the process and specifically around data and standardization technology, I want to hear perspectives on that and then anything else you have to react to either Jamila or to Brian's remarks.
Oh, great. Thanks, Mike. I love how you pick on the old guy to talk about technology and data. But no, like I like to say, there's no greater amount of data than there is today until tomorrow. And every day it will continue to advance and advance and advance. And that is a great thing, I think, for valuation. It's a great thing for the markets. It's a really great thing for investors. And how that data is used among the participants in the markets, whether it be the advisors, the funds, the pricing vendors, the valuation vendors, the accountants, the auditors, is all things that have progressed and improving. And you think that, like we talked a little bit beforehand about standardization, and I think it's a mistake if everybody has the same price, because it shows that there's really not a market and a true understanding of everything that's going on with a particular name. But at the same time, I do think that you are seeing more and more standardization, particularly as the valuation firms and others mature their processes, particularly, with all the governance that Jamila talked about, and then, all the process that goes into 2A5 that Brian mentioned. And I think you're seeing some maturation of all of that coming. And then you throw in AI. Like AI, that's a tool that is revolutionizing, the market's revolutionizing everybody's business. I use it every day. And, it's funny because you want to refine because you get this vast amount of data. But at the same time, it brings in things that I hadn't thought of, so making those queries too restrictive that I thought, I didn't think about that factor. And so I think you're seeing, a real advancement. I think what's interesting is some of that data, if it crosses a line of being materially and non-public, it may limit what you can use in your valuation process, which I think is an interesting factor. And then you also have, the risks of, particularly, we're talking about alts in retail. And so they have a board, they have a public board, and they have an alt firm that may have board slots on portcos. They may be part of creditor committees, and they're getting information. And then the question would be, and it's a question that's being asked often, is where is that line of what goes to a public fund board? Because that board, and you heard Jamila and all the requirements they're going to have to evaluate, they're hungry for the information, but at what point does it go too far? And so, I think there's a lot of issues when it comes to data and technology, but also those uses of the data.
Yeah, and I think just to pick up what Pete's saying, one of the other things to understand is that before 2A5, it wasn't like there was no sort of valuation process. The difference was the board was actually the one making the determination as to fair value. So the board was getting a massive, all of the information that Pete was talking about would get coalesced basically together and provided to the board as part of their sort of oversight function with respect to valuation. That is still happening in different ways now. The difference is that you have sort of professional advisors making the decision within the 2A5 framework with respect to valuation rather than the board being asked to do that themselves.
Sorry, the one thing I would add, and this was a difference when I ran exams, 5 years ago, is also in the data is what's in the news. When we would hear about a private fund thrown up gates, that was something we'd get a call from an angry investor. In a retail setting, we'd get a call from, a retail investor because they couldn't get through call centers that were getting flooded with calls. And so that's how we were hearing about it. Now, it's instant news on all the business channels. And I think that's different too, just how quickly that information's getting out to both the public as well as the regulators. So
that's really helpful. Thank you. And Blake, I want to go to you. So given your role as a chief investment officer, and if you talk about information, how do you think about the interaction between relevant information that the front office obtains from initial due diligence or ongoing monitoring, and then translating that information to the middle back office functions or elsewhere in the firm?
Yeah. So I've got to caveat this that we're a little bit different than most managers, because I think when people are thinking about private markets, they're thinking about what we at Cliffwater would refer to as a direct manager. This is a private equity or a private credit manager that's doing the deal. They're going out there, they're originating the investment, of course, underwriting, they're doing the structuring. We're different in how we call ourselves an open architecture model. By that, I mean we partner with those managers. So we're partnering with many of those direct managers. We are either giving them capital to invest, and or we are investing alongside them in those deals, which is commonly in industry terms referred to as co-investing, not to be confused by 40 Act co-investing defined term. I say that because our process can be a little different than if we were a direct manager where you have, these deal teams with a more concentrated portfolio of their deals. We work very collaboratively with our investment partners to procure the valuation information and their determination of fair value that then is audited under AC 820. I got that.
ASC.
I never worked at the SEC, although I got A's in accounting class. So we use that information. But I'll give you an example of what we do to kind of buttress that process. So we have a objective quantitative system. Algorithm would probably be too fancy of a term. Cliff wouldn't like me using that for this, but objective metrics that come up with a risk rating for all of our assets. And why is that important in a valuation context? Well, we believe, the valuation committee needs to pay much more attention to those investments that have higher risk ratings. Why? It's because really those investments are going to have more ambiguity around what the value is. So we have extra processes for that valuation committee to engage with the investment professionals who are covering those investments, and they have additional dialogue around what's going on at the company, where is it marked, is that appropriate, and very frequent updates, often ad hoc because, there are events happening along the way. So that's in our business kind of how we approach it.
Okay. I kind of want to get back to move the conversation back to structuring. I find it endlessly fascinating. And Blake, I'm gonna stick with you. You sit at a unique position because your firm, Cliffwater, is focused on the interval fund framework. In your view, why is the interval fund structure a good structure for exposure to private market assets? And then one addition to that, how do you think about the balance between providing meaningful exposure to private markets in the interval fund structure and also satisfying kind of investor repurchases and liquidity needs?
Yeah, so we've talked a lot about valuation, but liquidity is extremely important. And at Cliffwater, we say, hey, liquidity is the first, second, and third most important thing. But let's start with interval fund structure. It's interesting. It was designed by the SEC here to do just what we're talking about. It was designed in the 90s to allow for less liquid assets to be held in a structure under the oversight of the 40 Act to have all of these governance and protective trappings, but to do that with appropriately having asset liability match, and the way that's done through an interval fund is that there are controls on how much money can come out. So there's a limit on the liability side, and what that does is allow you to hold less liquid assets. So when we were kind of starting this business 7 or 8 years ago, we came upon this interval fund structure, and it was alluded to on the first panel, but the market has kind of coalesced around liquidity terms or redemption terms of 5% a quarter. So, okay, so 20% a year. And we said we want to offer a private debt vehicle to investors, and specifically we wanted to do that in direct lending, which is diversified pools of first lien loans. And we were, and I think are, one of the kind of institutional thought leaders in that asset class, and we've produced a lot of research. We developed an index in 2015 called the Cliffwater Direct Lending Index. So we could go back, to before the financial crisis, and this asset class, which maybe we could talk about later, but is actually highly transparent. Despite what the press wants you to think, very transparent asset class because people have mentioned since long ago BDCs filed Ks and Qs, so we could study it intently. And what, empirically, what we saw is on average, pools of direct lending turns over about 30% a year. So we said, well, it's kind of serendipitously, well, great, this is a structure where the liability side is promising 20% a year liquidity. We have assets that on average produce 30% liquidity. This works. Now, of course, that's an average, and so there's a distribution around it. So we put in place lines of credit and other tools to enhance liquidity to buttress if you're below average. So we we started the business, and then I was I'm a student of the marketplace, and I kind of look around, and everything is quarterly redemptions of 5%. And I was kind of scratching my head because you'd have tons of different asset classes that in these various analogous structures, whatever it is that John covered, everything from levered private real estate to funds of levered private real estate to venture capital. Or individual venture capital names. And I kind of think of we talk about private asset classes, the private markets efficient frontier. And, direct lending is like right down there at the origin. And you go way out and there's, venture capital. Inside that you get private equity. Somewhere in the middle you got real estate, real assets. And why is that important? Because as you go out, there are very different liquidity dynamics in these asset categories. Venture capital is like extremely illiquid. Not to go off a tangent, but there's correlation to valuation dynamics. Like first lien lending, a diversified pool of first lien loans is much easier to value. You're promised cash, certain payments in the future. Venture capital, very difficult to value. So it was and frankly to this day it's kind of confusing to me, but so bear with me. I'm using our story as an example. 3 years ago, I wanted to design a private equity product. And they have a discussion internally, and of course, distribution folks say, would want quarterly 5%. And I said, well, you can go find someone else to run that. I mean, this is private equity. So we determined that we were going to cut the liquidity terms in half. So we put a private equity product together that offers 10% liquidity a year, semi-annual 5%, because that's appropriate for what the asset class requires. And I'm a little nervous about it because, as far as we could tell, we were the first person to kind of do that. And was pleasantly surprised. And it goes back to the prior panel that, hey, everyone needs to remember these channels of distribution are well intermediated. There's the registered investment advisors. They're very sophisticated. They're fiduciaries for the clients. You got the banks, broker dealers. And it was refreshing because they said, wow, that's very thoughtful. This is great. And, the product's gotten great adoption. And it seems like, a few others are following that. But my Blair roundabout way of saying, I think the market as it grows up needs to be incredibly thoughtful around being real about the asset classes, the type of assets you're putting in, in all scenarios and states of the world, and being thoughtful about matching the terms of these structures to what you're executing on the investment side.
Yeah, I think someone on one of the last panel mentioned you should read the prospectus. That's actually really important for a bunch of reasons. But I think one of the things to pick up what Blake's saying, number one, as you ran into, the distribution channels drive a lot of the product structuring and the liquidity asks, and require some instructions around why maybe their liquidity asks aren't appropriate. So they are flexible, but they're also very demanding of what they expect, and that 5% a quarter is something they're used to for a very long time. So they tend to want to wedge people within that because that's an easier story, obviously, from their own sort of internal due diligence. But the other thing is, like, going back to kind of the prospectus, like a lot of as we see more, like to your point about like kind of the more liquid assets going in, like private credit turns over. Like we all understand that, but venture capital does not, just use the exact opposite. And, if you look at the prospectus, most of them will have a section where they talk about this is our liquidity construct, right? This is how we're going to seek to meet our redemption requirements. And I think it's important to kind of look at that and be comfortable with it and understand what that is. A lot of times it's a liquidity bucket, for example, which means the returns are going to be slightly lower than they would be if it was 100% invested in the illiquid assets. But that's the trade-off, that liquidity bucket, which is more liquid assets that are aligned but not identical to the asset class, are kind of the safety valve that gives you that liquidity. Or like leverage, as you mentioned.
Yep.
Blake, that's the other thing.
Well, one thing I'd mention is, I've spent a lot of time reading the fund docs. The fund docs are great. They cover every risk. John's doing his job. Even if a meteor comes out of the sky, it's covered in terms of risks.
I can even point you to the exact page that's on. But
I really I think it's going to be a sales practice issue as more and more of these go into the retail setting. It is going to be those reps that are selling a product. I like to refer, like Director Daly refers to his mother, I refer to my father, who's watching today. Hi, Dad. It's something that, what would he be told that would be unsuitable for him under the broker-dealer standards are not in his best interest. And given his age, given his, his time horizons, given the liquidity needs, I think that is where the risk is going to be, because if you read the fund docs, they're beautifully written. They cover all the risks, and unless something is a real foot fault that happens at a particular firm, I think where it's going to be is where it's offer and sold. And we're seeing very astute distribution channels in the markets that are asking a lot more questions, and they are demanding more information from the producers of these products, which is a good result. That actually is a great result for purposes of ensuring that the investor ultimately is not sold something that's not suitable for them.
Does anyone else want to jump in on the panel on structuring 40 Act wrappers or anything?
Maybe just an observation that I've seen, and that is the convergence here is resulting in some people who are, maybe in the 40 Act space, are very used to the concept of striking a daily net asset value. And for them, valuation is a daily process that they adhere to. In the alternative space, that is not necessarily where they're starting from. Some of them may be used to more of a monthly valuation process. So, as managers sort of step into this arena, it is something of a muscle that needs to be developed in terms of increasing the frequency. And you have to, in the alternative space, because information may be limited or lagging, you have to triangulate with multiple data sets to really come up with a reasonable estimate sort of in between the normal mark period, if you will. So it's something that, as folks, it's really more from the business perspective of running funds that people have to be mindful for.
Well, I just related to that. I think an important, on the subject of valuation, a very helpful dimension is the level of diversification in a fund. So we're fortunate because of just the inherent nature of our investment strategies, where we're partnering with many managers. I mean, we have thousands of line items, very, very diversified. Why is it important? When you're doing monthly, daily valuations, the more diversification you have, you benefit from the law of large numbers. So you're never going to get every security exactly right. We refer to that as estimation errors. When you have a big diversified portfolio, when any single line item is a very small percent of the portfolio, the averages cancel out. We say that the estimation errors end up canceling out. And importantly, those estimation errors are unbiased. And to the point of, we have the process in 2A5, we're reporting on that dynamic to our valuation committee and board about how we'll look back and say, well, hey, how accurate was you get more information, quarter lag when the information comes out, and go back and say, hey, how accurate was our NAV? And it's been incredibly accurate. But because we're massively diversified, I think it gets trickier the more concentrated you are. I mean, especially if you're going to do a daily NAV. But in general, it's just now on the other hand, you have all these advisors to focus in on each of those positions.
That's helpful. I want to shift gears a little bit and talk about another topic that I know retail investors care about deeply, and that's fees. John, I'll ask you, private market investments have typically had a different fee dynamic relative to what retail investors expect in the public markets. How are you noticing the industry thinking about fees when designing retail-oriented products? I mean, for instance, are boards thinking about fees associated with private market investing similarly or differently than how they are thinking about it for public markets in connection with the 15C process? Or
Yeah, no, it's a great question, Blair. I mean, what I would say is, the fee dynamic with respect to private funds is vastly different than it is with respect to similar asset classes in the public markets, even for the private wealth channels. And that's, driven by a couple of factors. Number one, for private funds, you have large institutional investors writing very large checks. And they are able to negotiate side letters and other things like that might modify the type of fees or might give them co-invest rights, for example, or things like that basically change their outcome relative to other investors. And that is something that's perfectly allowed with respect to private funds. You cannot do that in a 40 Act product for a whole bunch of reasons. There's sort of a structural limitation under the 40 Act that requires basically, at least for the asset management fees, that it be the same experience across all shareholders. And so as a result of that, it means that, really what we see is actually a kind of a reverting to the norm, if that makes sense, right? The distribution channels have their expectations with respect to what the asset manager fees will be like for these products. They have due diligence processes they go through. If you are an outlier, you will get asked about that, and it will be more difficult to get into those systems. And then to your point on the 15C process, one of the really great features of the 40 Act is really the fact that you have this board oversight function with respect to the asset management fees that are charged. And it's an ongoing annual kind of look back where the board and the independent directors have to basically reapprove keeping the IMA in place. And that is a very robust process. One of the key features is you have to gather data from your peers. What are your peers charging? As part of that process. So you have a natural level set. Even when you're starting out, you're going to look at the fees around your peers, and the board has to be comfortable that you're in line with that. But that's also an ongoing annual sort of review process as well. So not only do you have kind of the market pushing for, to some extent, a little bit more uniformity with respect to the fee loads across these different fees, but you also have the 15C process as sort of a second line of defense, so to speak, to make sure that you don't have sort of outlier fees for some of these products. And just as a general matter, they do tend to have base management fees, which is where it's just an AUM-based fee based on effectively net asset value in most cases. Sometimes gross assets, but typically net asset value for the private wealth channel vehicles. And then most of them are structured, not all, but most are structured as having some sort of incentive fees. A lot of those were based originally on sort of what we saw in the BDC space and the non-traded REIT space. But we've seen variations of that, again, applied to the other asset classes as well, even for the non-40 Act products, which I think just tells you how strong that sort of market push is to have very similar fees across all of these types of products, kind of being almost agnostic as to the actual asset class and more focused on kind of keeping the experience for investors similar across all the different vehicles.
And go ahead.
Well, I was going to chime in. What was going to be my advice for your dad, Pete, who's watching, which is so John mentions incentive fees. So, a big emerging I think this is will be an interesting thing to watch because private equity, is a big emerging category in these evergreen vehicle structures, but it doesn't just apply to private equity. People need to be very aware that the way incentive fees work typically on these type of products is very different than traditional private equity, how the industry's been doing it for decades. Okay, why? The incentive fees in these vehicles are typically structured, you could call it as like hedge fund style fees, meaning the incentive or carried interest, sometimes referred to as that, is crystallized and collected either quarterly or annually on unrealized gains, okay? The history of private equity and these other asset classes is typically the carry interest is only earned and paid on realized activity, meaning the investment is sold. You have value, come back to valuation clarity. The investment is sold, turned to cash, and typically the deal teams are big beneficiaries of the carry pools, as they should be, because they're working hard to create that value that Cliff talked about. There are risks that people need to be aware of related to crystallization of carry for investment professionals on unrealized gains. And I think it'll be something that probably the industry will all talk about a lot more in the coming years.
Yeah, the one thing I'd add to what John spoke about is a traditional alt firm that gets into the public space, and they go through that 15C process, and they're ultimately could lead to some fee compression. How do they handle pre-existing alt strategies that they've negotiated and have had funds for a long time that may have higher rates ultimately than what the public fund provides, and how they manage that conflict within their organization? I know like compliance folks are thinking about that as they delve into this space. So.
And one other final thing, I think compliance folks are also thinking about, and I know you'd agree, Pete, kind of the level down of fees and expenses for the fund and how those are being managed. So are things being pushed down to the investors? What's happening with, the process or the matrices for expense allocation? So you start at the top where you did, John, but then the level down is what's actually happening with the fund's expenses and how are those being determined? Are they shared amongst funds? Is there a really good allocation process for that? Because I do think investors are starting to really care and pay attention based on some of the recent, or not so recent, but some previous enforcement actions. So lots there on fees and expenses.
I was going to say, you had mentioned documentation once before. That is critical
Yes.
on any sort of expense allocation point, is having told people you're going to do it, which I think hopefully if we've done our job, you've told people correctly. But I think more importantly, it's having a very well-defined system to make sure that it's being allocated appropriately. So I'll just say sometimes we end up suggesting time cards, which people hate, but it is one way to sort of manage some of that as well. So.
All right, well, I know we're running short on time here. It's been a great panel. I think I'll just ask one final question as a kind of lightning round, closing thoughts. And that's just general, as you look, 12 to 18 months in the future, what governance, valuation issues, structuring issues kind of will dominate the conversation, and what do you think we'll be talking about? I guess we can just go down the line. Start with you, Pete.
I think there's a lot of different liquidity solutions that are out there, and we're hearing about them in the headlines, whether it's a line, whether it's an advisor stepping in, whether it's gates being thrown up where there's not a liquidity. And I think that 12 to 18 months from now, I think you'll see more clarity in approach. There may be some solutions that step in that can be more helpful at times of market stress for these managers and for these funds to meet redemptions. I think that's one area that I think I'd hope we see. So.
Yeah, I think one of the things I think that's going to be a dramatic change over the next 12 to 18 months is really the the sort of democratization of capital, so to speak, within the 401k space, and really the greater access for private market investments in that space. I think it's going to increase sort of the emphasis on valuation, not that it's not very intense already, but I think it's going to increase that emphasis outside of just the 40X space as well. I think there's going to be a broader focus on it. But I also think it's going to potentially in some ways create more sort of uniformity around market expectations, because it's potentially a very large amount of capital coming in, looking at these illiquid assets and trying to generate greater certainty around it. I think you mentioned AI, Pete. I think there's going to be a lot of focus on finding ways to create even better valuation processes, and I think that's going to be, I think, a key driver for it, just with the amount of capital coming in.
I'd agree with that. I had AI and tech the top of my list because I think the service providers that I mentioned are going to start moving to more dynamic AI processes, and those need to be vetted and governed by anybody that's utilizing a pricing service, a fund administrator, any and everybody, right? An auditor. Like a lot of those things are being really run by AI kind of algorithms now. So that's going to be huge. But then I also think, to kind of take further your 401k comment, John, the accredited investor definition has been revisited for a number of years. But even more recently, I think the IEC with the SEC, that committee has kind of brought it back up to the commissioners to consider. If that definition changes, if more folks are able to be now accredited investors, it will be important for more enhanced disclosures on these private markets investments. It's going to be really critical for not just mom and dad, but younger, newer investors to understand what they're getting into and what their risks are. So
It's all the folks investing on their smartphones.
there we go.
Yeah.
Yes.
On the subject of valuation, the one thing been discussing a lot is how valuation is done for secondary purchases of private funds. So an example, what I mean by that is, there's a very big and fast growing market of, let's say institutions want to sell their limited partnership interests, and this is very healthy for the market. It's a great development and will facilitate all this activity. But what's interesting is the accounting treatment for that under ASC 820 is if you buy such interest, let's say at 80 cents on the dollar, immediately you're marking it up to 100 cents on the dollar under what something is referred to as practical expedient. And in a lot of instances that's very appropriate, but there are especially at least a material subgroup of instances where again, the secondary market has become very big and well functioning. The market isn't that inefficient where you get dramatic. Let's say you buy something at 50 cents. Maybe you did a really great analysis and that's worth 55 cents, maybe even 60 cents. You did a better analysis than the next guy. These are often very brokered, auction processes. But you're then marking it up to 100 cents. And it can create in these vehicles a lot of distortions that aren't great, given these are, they may be technically closed-ended structure for regulatory purposes. These are open-ended in terms of investors flowing in and out. And so that's since this panel is on valuation, that is my valuation topic for the next 12 to 18 months. I'd say my recommendation is that discount should be smooth, amortized over some period of time.
I guess I'll go back on the technology train and basically say that I do think that technology will become an increasingly important part of the valuation process, and I think that will be you'll see just technology, and whether it's AI or not, I'm less certain of, but technology will be useful to rapidly synthesize data about the portfolio companies and help people with the demand for more frequent valuations.
All right. Well, I think that's a great place to close. Thank you for this thoughtful discussion, and thanks to our audience for joining us today.
Thank you.